Let's remind ourselves of the question. How did the dot-com era create instant millionaires and then delete them like a corrupted file? The answer is simple. People bought the future before it had a business model. But to understand how that happened without getting trapped in a spreadsheet funeral, there are a few things you need to know. And no, it is not in a boring professor tone. This is 13-minute finance style. Simple, fun, and straightforward. Welcome to 13-Minute Finance. Picture America in the mid-1990s. The jeans are huge, the phones have antennas, and every computer sounds like it's about to explode. Then the internet shows up. It is not today's internet. This one screams like a haunted fax machine. You hear dial-up and you think, either I'm connecting to the web or I'm summoning something. But even though it was slow and weird, everyone could feel it. The internet wasn't just new tech. It was a new world where business could happen without buildings. And when humans find a new world, they don't ask, is it stable? They ask, how do I get rich here first? Step 1 was access. Browsers made the web usable. Suddenly, normal people could click around, see images, and feel like they were living inside the future. Step 2 was a single, dangerous message from the stock market. You don't need products to go public. You just need growth, hype, and a story that sounds like destiny. That message spread like a meme before memes existed. Founders realized, I don't need to build a great business. I need to sound like I'm building the future. Investors realized, I don't need to understand the product. I just need to be early. That is the seed of the dot-com bubble. Now fast forward to the late 90s. Every company tries to glue .com to its name like a designer label. Because in that era, .com wasn't a website ending. It was a magic spell. If your company had .com in the name, people assumed you were innovative, you were unstoppable, and you deserved a ridiculous valuation. Wall Street started funding ideas the way a nightclub funds bottle service. Nobody knows what they're paying for, but it feels important. A startup could walk in with a sketchy logo, a vague sentence like, we're reinventing commerce, and a founder who says first mover advantage 3 times, and suddenly they're worth $100 million. That isn't investing. That is astrology with spreadsheets. By 1998 and 1999, the market wasn't valuing companies. It was valuing vibes. IPOs felt like celebrity weddings. Confetti, headlines, champagne, phones ringing. Everyone acted like they discovered the next Microsoft. And regular people joined. Teenagers day traded from bedrooms. Your aunt bought tech stocks because her hairdresser said, it's going up forever. A dentist quit dentistry to day trade because charts are easier. Meanwhile, tech forums were basically casinos with comment sections. Now, important point, the internet really was changing the world. The problem was timing. People priced a future with perfect internet infrastructure while using an internet connection that died if someone in the house picked up the landline. That mystery between valuation and reality was the entire bubble.
To understand the madness, watch 2 types of companies. Type A is real demand, real path to profit. That is rare. Type B is loud marketing, no math. That is everywhere. Let's talk about Type B, because they made the bubble a bubble. Pets.com is the classic. They sold pet food online. Today that sounds normal. Back then, it was insane, because pet food is heavy, low margin, and already available in supermarkets. Shipping giant bags to people's homes was expensive, so the company often lost money on every order. And investors saw those losses and said, interesting, here's more money. This is the dot-com disease in one sentence. The market confused spending with growth. Burn rate became a flex. Losing money fast looked like momentum. So founders tried to lose money faster, because the faster they lost it, the bigger the next funding round was. Now add the real fuel: cheap money, tax incentives, easy capital, and an IPO frenzy. When money is cheap, mistakes become fashionable, and the incentives got messy. Banks wanted deals.
Analysts wanted headlines. Founders wanted exits. Everyone wanted the rocket ship photo. So optimism was manufactured at scale. During the peak, the logic flipped upside down. Some people basically said, being profitable is bad because then you won't get an internet valuation. Now we hit the part that actually murders bubbles. Bubbles don't pop because vibes get sad. They pop because math shows up with a baseball bat. Here's the math. Customer lifetime value should be bigger than customer acquisition cost. LTV must be greater than CAC, meaning a customer should make you more money than it costs to get them. Many .coms did the opposite. They'd make $10 over a customer's lifetime, but spend $60, $70, even $80 on ads to acquire that customer. That isn't growth. That is bribery. And it only works if investors keep handing you cash. That cash becomes your oxygen tank. But once investors stop, you don't slow down. You suffocate. Now let's zoom in on what the peak actually looked like on the ground, because this is where bubbles become contagious. During the late 90s, marketing turned into a weapon. Companies weren't spending to sell a product. They were spending to look inevitable. That's why Super Bowl ads became the ultimate flex. Imagine spending millions for 30 seconds on TV when your website isn't even finished. One ad was basically, "Our site launches soon, please clap." And people did, because the market wasn't buying a company, it was buying a badge. I was here early. And the more money a .com burned on ads, the more serious it looked. That is backwards, but bubbles are backwards. In bubbles, looking big matters more than being real. Webvan is another perfect example. The pitch was beautiful. Groceries delivered to your door with military precision. The execution was a disaster. They built expensive automated warehouses before they proved demand. It's like building 10 airports before you checked if anyone wants to fly. They tried to scale logistics without learning logistics. So costs exploded, losses stacked, and the business collapsed like an overcooked souffle. Then there was Priceline. The idea sounded smart. Airlines have empty seats, so let customers name their price. Cheap flights for consumers, extra revenue for airlines, and a cut for Priceline. But the dirty reality was simple. Sometimes the math didn't work, and the company had to eat losses to make the promise happen.
When your model depends on miracles, you aren't running a business. You are running a magic show. And at the highest point of the mania, you get a symbol that only markets can create. The globe.com. It was an online community, basically early social media. The stock exploded on day one, like the market injected it with pure delusion. Cameras caught the CEO dancing on a table, celebrating like he just conquered gravity. It became the perfect snapshot of the era. People confusing a rising stock price with personal genius. 6 months later, the stock was basically a rounding error. Because gravity always returns. Here's the deeper pattern. When a market is obsessed with growth, it starts using fake words to avoid real questions. Revenue becomes traction. Losses become investment. Burning cash becomes scaling. And profit becomes later. Later is not a strategy. Later is a prayer. Quick detour to Wall Street, because bubbles are not just about dreamers. They are also about incentives. Banks wanted IPO fees. Founders wanted moonshot valuations. And analysts wanted to be the voice everyone quoted on TV. In a boom, the person who says buy the loudest gets rewarded first. Even the IPO lottery had a tilt. Big institutions often got the good allocations early, while normal people showed up after the first day fireworks, buying late at crazy prices, because that was when the hype was loudest. And here's the quietly savage detail. Insiders sold. A lot. When the market feels like a guaranteed escalator, the people closest to the machine sometimes take the stairs down with bags of cash. That doesn't mean everyone knew the exact top, but it does mean plenty of people understood the models were fragile. If you wonder why bubbles hurt hard, it is because the party is public, but the exits
are private now. So when the decline started, it wasn't one single pin that popped the bubble. It was a stack of pins arriving at the same time. Higher rates, tighter capital, bad earnings, and the growing realization that many companies had no path to profit. That combination doesn't just pop a bubble, it drains it. And once the oxygen drains, something else happens. Language changes. During the boom, every headline was a love letter. During the bust, every headline was a warning label. But beneath the drama, the real transition was quiet. The market stopped rewarding loudness and started rewarding survival. Survival is boring. Survival is budgets. Survival is customer retention. Survival is unit economics that don't break when ads get expensive. That's why the survivors weren't always the coolest. They were the most disciplined. And this is the point where you should take the lesson and apply it forward. Because the dot-com bubble is not just history. It is a template. Every time a new technology appears, humans repeat the same emotional cycle. Shock, hype, gold rush, overbuilding, reality, collapse, rebuild. So if you want to spot the next bubble, look for these signals. When people say profits don't matter, when valuations are justified by slogans, when the story is stronger than the balance sheet, and when the phrase, "this time it's different," becomes normal. None of those guarantee a crash tomorrow, but they do tell you the mindset has shifted from investing to gambling. You don't need to hate technology. You just need to demand math.
Ask simple questions. Who pays? How much? How often? What it costs to deliver? And what happens when funding gets tighter? If the answers are fuzzy, the valuation should be fuzzy too. If the answers are solid, then you can survive volatility without panic because you aren't betting on vibes. You are betting on a machine that produces cash flow. That's the real dot-com lesson. The future is real, but pricing can be fantasy. And when fantasy gets expensive, the market always sends the bill. So when you look at hot sectors today, AI, biotech, whatever comes next, ask the questions that the bubble tried to delete. Who has real revenue? Who has unit economics that survive without infinite funding? Who can last when the oxygen tank is removed? Because hype is loud, but cash flow is undefeated. And that is the dot-com bubble. A generation priced the internet like it was already finished. Then the market forced everyone to wait for reality to catch up. History helps you to predict future. Stay rich till next video.